Welcome. You've stopped in to view this video presentation because you're concerned with the past, current, or future performance of your 401k or other mutual fund investments. The 401k is what most Americans are counting on to take care of them during their retirement. Yet of the more than 49 million Americans with 401ks, the average return on over 22,000 mutual funds over the last several years is negative or slightly positive. That's certainly not going to get the job done. Amazingly, on the average, funds using this service you're about to view are significantly positive. I have two questions for you. Do you know if you have the best or worst performing fund selected in your 401k? Do you have any kind of risk management plan for when the next market crash happens? If you cannot definitely answer yes to both of these questions, then sit back and for the next 10 to 15 minutes, let me show you how and why you're being misled by Wall Street and what you can do to change it. If you lost 50% in the market in year one, but the market rebounded and you grew 50% in year two, your investments would be even because your average annual yield would be zero. That's simply not true. If you had $10,000 and lost 50%, you'd be down to $5,000. Then in year two, you make 50%, but your account value only grows to $7,500. While the average yield is indeed at 0%, your account value remains down 25%. As you can see, the average yield means absolutely nothing. It's simply a sales tactic, a form of misdirection or misinformation. Oh, by the way, what would you have needed to earn in the second year in order to get back to your starting point? The answer is 100%. And how often has that happened? As you can see, the market hasn't even gained 40% in any 1 year over the past 50. Most mutual fund managers use the S&P 500 as the benchmark for their funds, yet the S&P outperforms 73% of them. That's why we use the S&P to gauge market performance. What's obvious here is the market goes up, but it always comes back. Each time there are gains, losses inevitably follow. Yet Wall Street's solution to this pattern is to stay the course, weather the storm. This is known as the buy and hold strategy, and most of you are using it right now. Using this strategy, what would you do if the market was down at the point you plan to retire? This is precisely what happened in 2008. What you really need is a risk management strategy that has the goal of helping you attempt to take advantage of the majority of the market upswings while avoiding the majority of the market downturns. Now, I know some of you are already thinking there's no way anyone can time the market by correctly picking the highs and the lows. And you're right, no one can. But there are some things that you can do to attempt to safely protect and grow your retirement. Let's look at the market over an 8-year period from 1995 to 2002. Let's assume you're contributing $10,000 per year over this 8-year period. On the left side, you see the actual yield for the year and the average yield for the years prior. You also see the effect on your account value over the years. If in 1995 you contributed $10,000 to your account and the account grew by 34.1%, at the end of the year, your account value would be $13,411. Your account continues to grow until 1999, when the value of your account has risen to $102,773.60. At that time, you should have exited, but you didn't, because you were using a buy and hold strategy. Over the next 3 years, you gave back all your gains, even while you continued contributing $10,000 per year. Your advisor tells you not to worry because the market is averaging 10.6 over the last 8 years. Believe it or not, this is true. Does it matter? Not in the least. Throughout these 8 years, your advisor has been collecting between 1.5% and 2% per year in fees for managing your money. They get paid regardless of whether or not your money grows. Your account value has dropped to $81,856.04, even though the market has averaged 10.6 over the last 8 years. Your account has grown by a mere $1,856.04, representing an actual yield on your $80,000 investment of 0.5%. This is your buy and hold strategy in action. Right now, this minute, let's agree on one thing. The buy and hold strategy simply doesn't work. It has been forced on you by Wall Street to keep you invested in the market so they can keep charging you fees for managing your money. Remember, they can earn 1.5% to 2% or more each year on the total value of your account, whether your money goes up, down, or sideways, depending on the fund. Without doubt, the goal of your retirement account is to maximize your return on investment. To do so, you may need to move away from the buy and hold strategy. To do that, you must be able to find out how to answer yes to these two questions. Do you know if you have the best or worst performing funds in your 401k? Do you have a risk management plan for when the next market crash happens? This is where the protect and grow strategy comes into play. We use a bull-bear SPX market signal tied to the S&P 500 index, also known as the SPX, which has the goal of avoiding downward trends in the market. We call this the capital preservation mode. The market signal also has the goal of capturing the majority of the upward trend in the market and then exiting, thereby locking in gains. The signal is given on the S&P 500 index, and the protect and grow strategy shows how the mutual fund performs if they applied the market newsletter signal. Using the buy and hold strategy over the last several years, the average return on investment for over 22,000 funds has been negative or minimally positive. Compare that to our protect and grow strategy using the market signal, which has delivered excellent growth on an average of over 22,000 funds over those same 6+ years. Bear in mind, we never touch your money. We don't even have access. Now, which strategy would you choose? Buy and hold or protect and grow? The protect and grow strategy has 3 components. The first component is the mutual fund analyzer. This simple tool helps you answer in mere seconds if you have the best or worst historically performing funds in your 401k. It has over 22,000 funds in its database. It has over 20,000 companies' 401k plans already pre-built into the system, with more being added on a consistent basis. In addition, it compares buy and hold side by side with the performance of funds had they used the market newsletter signal. This brings us to the second component, the market newsletter signal. This is an educational risk management plan that focuses on one key concept. It is not what you make, but rather what you keep that counts most. The focus of this signal is to try to get a majority of the uptrends, while most importantly attempting to avoid a majority of the downtrends. And then comes the third component, the alerts. We know you are busy and you do not want to log on to a site every single day to keep up with the market. So we provide email alerts and mobile phone text alerts to let you know when the newsletter signal has been updated. Let's talk about how we're able to accomplish this. First, we track every mutual fund on the United States Mutual Fund Exchange, and we analyze their performance in a variety of ways. If you recall the flash crash in 2010 when the market dropped 1,000 points in 15 minutes for no apparent reason, then you have witnessed firsthand the impact the market can have on your retirement account. Do you have a plan to help you be ready for when the next market crash happens? By analyzing where orders are most likely accumulated in the market, we are able to gain insight to what investors are poised to do. Then, we are able to attempt to anticipate market direction, and this is where the bull-bear market newsletter signal comes into play. Note, this is not a day trading approach. The bull-bear market newsletter signal typically occurs 1 to 4 times per year. And of course, we send you email and text alerts to make it where it's easy for you to keep up with it. In addition, some of you may be worried about how much time it would take to actually implement this strategy. It takes about as much time to implement this strategy as it does for you to order 3 pizzas a year. Let's take a look at 2005. You'll notice the yellow line that looks like an electrocardiogram. This is the daily close of the S&P 500 index. In fact, if you're a day trader, this could very well represent your heart rate. The blue line represents the S&P 500 index's 50-day moving average and is a key component of the market signal. The red and green lines are proprietary diagnostic indicators that are also used in establishing the market signal. Earlier we spoke of being able to take advantage of market upswings and avoiding market downturns. If you had been using the market signal in 2005, you would have been notified of the bull signal for the market here, and then again here, where you may have chosen to enter the market. All in all, we had a bull signal for less than 5 months in the entire year. The beginning of the blue section is where the long bull signal was given to our subscribers. This is the signal that the market is anticipated to rise. Subscribers at their discretion may choose to put their money in previously high-performing funds during this period. At the end of the blue section, we give a bear or exit signal, which was indicative of the fact that we anticipate the market will no longer be able to sustain growth. Subscribers, at their discretion, may choose to move funds to money market, cash, or stable assets during this time. During times when subscribers are in the market, they are attempting to grow their investments. During times when they are out of the market, they are in a cash position attempting to preserve capital. Notice that the signal is not given at the absolute top of the market. Again, no one can predict that. But what you can see is the signal attempts to take advantage of the majority of the market gains while attempting to be in a cash preservation mode during the market downturns. As we move into 2006, subscribers who used the market signal were out of the market for the first several months of the year. Yet once the signal was given, subscribers who used the signal were able to enjoy a significant period of growth prior to exiting the market near the end of the year. Along the way, the bear signal is adjusted upward to ensure that a client, at their discretion, can exit the market, control risk, and ideally lock in profits while preserving capital and awaiting the next bull signal. In 2007, the signal was given near the end of the first quarter. Subscribers who used the signal took advantage of decent growth and then exited the market. Subscribers then remained in a cash preservation position while the market sorted itself out for 3 months. And then a new entry signal was given. Subscribers who used the signal remained in the market for approximately a month before exiting prior to the beginning of the downturn at the end of 2007. Everyone remembers 2008. It's hard to forget losing 40 to 50% of your life savings. The signal was given, and our subscribers who used the signal took advantage of a small window of growth. Notice that the exit signal was given prior to the market beginning its decline and well before the free fall and absolute collapse that occurred during the last half of the year. 2009 was the year when our signal gave subscribers the opportunity to use the signal and enjoy a long and steady ride prior to exiting the market near the end of the year. Due to our friends, the high-frequency traders, the stock market halted trading on May 6, 2010, when the fragile exchange dropped nearly 1,000 points in less than an hour. Notice carefully how the market signal was issued the prior day. Our subscribers who used the signal remained in a capital preservation position until the bull signal was given, and then subscribers who used the signal were able to re-enter the market and then exit prior to the end of the year to avoid the market choppiness due to seasonality. Let's take a look at a recent client. On the left side is the 5-character ticker symbol for each mutual fund. The star represents the overall strength or stability of the fund. The first crooked line is the fund's performance over the last 6 years using the buy and hold strategy, while the next line represents how the fund performed using the bull-bear SPX market newsletter signal. The red and green columns represent the actual performance of $10,000 invested in each fund over the past 6 years. The first column shows the result using buy and hold. The second column shows the result using the market signal. If the box is red, then the fund is in a loss position. If the box is green, then the fund has a profit. You can see that most of the funds are profitable using the market signal, yet they are in a loss position on buy and hold. The next 2 columns show the percentage yield, and the final 2 columns represent year by year win-loss. This will allow you to easily and within seconds know if you have the best or worst historically performing funds in your 401k. With this service, you get access to this amazing tool and video tutorial, or we can do it all for you. This chart shows a summary of $10,000 invested in each of the 19 mutual funds available within Guidestone's 403B plan. Using the buy and hold strategy, the employee would have lost $45,254.51 since 2005. Using the protect and grow strategy, that same investor would be up $70,484.92 using the very same mutual funds. This is a difference of more than $115,000 over 6 years. The overall performance with buy and hold is a 4.49% annual loss, while the protect and grow strategy showed an annual gain of 5.47%. Let's look at BNSF, again assuming an investment of $10,000 per fund across each of the 14 funds available. The difference between using the buy and hold strategy versus the protect and grow strategy is more than $75,000 over 6 years. This kind of difference is impossible to ignore. American Airlines is a dramatic example. The difference between buy and hold and protect and grow is more than $200,000. Bear in mind these are real numbers using the exact same mutual fund. This summary compares 401k performance at 10 companies across the nation. Current mutual fund performance using buy and hold is represented in red. The performance using the protect and grow strategy is represented in green. Quite frankly, no matter what companies we analyze, the results seem to be the same. Mutual funds leveraging the protect and grow strategy have consistently outperformed those same funds using buy and hold. So let's talk about what exactly we can do for you. First, we'll analyze every mutual fund choice available in your 401k or 403b plan and provide you a report sorted by performance. Remember, we aren't trying to have you change your advisor or get out of your 401k. We're simply measuring mutual fund performance using buy and hold compared to that same fund's performance using the Protect and Grow strategy. In addition, many of you may have mutual funds and accounts outside of your 401k. These may be in IRAs or other types of investment accounts. Since we analyze over 22,000 mutual funds in the country, we'll be able to provide you a simple and powerful report on the top 20 performing mutual funds and others that you may have interest in. Lastly, we'll provide to you the alert on the Bull Bear SPX Market Newsletter Signal. This invaluable tool helps you make better investment decisions and is a valuable research tool. It will identify bull growth mode or bear capital preservation mode. This incredible service is available via email alert and mobile text alert to subscribers who subscribe to our service, and via the video newsletter you can access by logging in. In addition, you can obtain direct access to the mutual fund analyzer itself. We developed this service for the average American, but make no mistake, we have many wealthy subscribers who leverage this very same service to attempt to further increase their net worth. Over the last 15 minutes, we've shown you exactly why the buy and hold strategy simply doesn't stack up. The Protect and Grow strategy with the market signal is simple and doesn't require a lot of time or effort on your part. This service is objective. It takes all of the emotions out. It has a 6-year track record. It is here for helping Americans like you desiring to learn how to protect and grow your retirement accounts. This brings us back to the 2 original questions. Do you know if you have the best or worst performing funds currently selected in your 401k? Do you have a risk management plan for when, not if, but when the next market crash happens? With a short 15-minute phone or in-person appointment, we can answer both of these questions for you. If you have any questions or would like to discuss how you too can take advantage of this exclusive subscription service, please contact us today.